Welcome to LYT Mode. Hope you all are doing good in this tough time of pandemic. In this video, we will discuss about a very interesting phenomena which is occurring in this tough corona era time. What's happening? Our forex reserve, which RBI maintains, is rising, and after hitting $500 billion mark, it's now at an all-time high of 538 billion US dollar. So in this video, we will talk about forex reserve and what are the constituents, how it helps the Indian economy, and all those nitties and gritties about forex reserve. So first, test your knowledge through 5 MCQs. So this is the first question. This is second question. You have to pause the video and check your knowledge whether you are able to answer all these 5 questions correctly or not. If you are able to answer more than 3 questions, then you are going good. But if you are not able to solve 3 questions, then you are not on track. Either you are preparing for RBI, UPSC, or any other banking exams in which economics is a basic thing which you should know. So I hope you would have answered all these 5 questions, and by the end of this video you will be able to solve all these 5 questions. So don't worry if you are not able to solve 5 questions, and few questions are there also from UPSC 2019. So let's move, and at first you should know what is forex reserve. So I have brought the definition from IMF, the standard definition. So it is nothing, it's just the external asset which a country reserves for balance of payment financial need. Now, what is balance of payment? So I will take you back to 1991 when the Prime Minister was PV Narasimha Rao and the Finance Minister was Dr. Manmohan Singh. So at that time, what happened that India got an external shock due to Gulf War and several Cold War crises as well. So we were left with only $15 billion, which was not enough for a month also. So India went with LPG, liberalization, privatization, and globalization. IMF give India the condition that you will have to open your economy, and that became LPG. So at that time, India started keeping more forex, which is external asset. Okay, so later in this video we will talk about what are the external assets which are there in the forex, like FCA, gold, SDR, and reverse tranche position. So in crux, you should know that it is an external asset that a country's monetary authority can use to meet the balance of payments financing needs. It's the worst, in the worst case it should be used, like people tell that coronavirus is going on, RBI should give more money to current government. So dividend is different and forex is different, so don't mix up both things. Like last year 1.76 lakh crore rupees RBI gave to government to contain fiscal deficit as well for recapitalization of PSBs to meet the Basel norms. But you can't give the forex for those things. Forex is only in that case in which everything is on a stake. Okay, so let's move. And most nations hold the vast majority of their FCA, which is foreign currency asset reserve, in US dollars, followed by euro, pound sterling, yen. The reason is simple. US dollar is an international currency, and euro, sterling, and yen is followed because UK and then Japan. These are economy which are very powerful, so they are less prudent to the shocks. That's why people keep these currencies. Moving forward, foreign currency reserves are vital to a nation's economic well-being. Obviously, how much forex you have, that gives a perception of your economy to the outer world. So if FDI and FPI have to come, if you know about FDI, it's foreign direct investment, which is for long term. Like Facebook has got a stake of 10% in Geo for 50,000 crore. So that's a long term investment that will create jobs, that will have a spillover impact on Indian economy. So that's FDI, and FPI is for short term in stocks, bonds, debentures. So that also depends on how well your forex is. Like no one is going to invest in Pakistan because their forex is something like $10-12 billion, and that also depends on how the China and Turkey and Saudi Arab's mood is. Their forex depends on the mood of these countries, but our forex reserve depends on the NRIs working in foreign countries, the RBI's hard work, our country's policy, and the hard work of our people. And don't forget the IT industry, which is $190 billion worth. Moving forward, without adequate reserves, an economy can grind to a halt, and a country may be unable to pay for critical imports such as crude oil, etc. So let's assume we are importing fuel from Saudi Arabia. So they don't take payment in rupees. Iran was taking the payment in rupees because there was the understanding like we will provide the exports in the Iranian currency, and we will also get the imports like oils in rupees. But after US sanctions due to nuclear issues with Iran, India is not importing oil from Iran, and the Chabahar deal is also postponed. So that's why what's happening is we are getting everything, every critical imports like crude oil, gold, electronics, which is around 50% of the total Indian import in dollar. So we need at least $500 billion for 1 year of import, because our 1 year import is around $300 billion. So if we have $500 billion, it's more than enough. Means it can go to 1 year plus 6 months also. So that's more than enough. So this is a good thing. So I think by now you are able to understand what is Forex reserve. So let's move. Now here I have brought two important data. On the left hand side you can see the China foreign exchange reserves. On the right hand side you can see the India's foreign exchange reserve. Now why I am comparing? Because at a time in 1980s, the Forex of India and China was almost equal. Let me give you a fun fact. In 1980s, the electronics export of India was more than China. You can quote it anywhere. In 1980s, the India's export of electronics exports was more than China. But now you know what's happening. The trade deficit of India, China, and where China is going on. So what happened so drastically? In 1979, Deng Xiaoping, he brought major economic reforms which India brought in 1990s through LPG. So here you can see, I have in this data you can see this is $200 billion, this is $400 billion, this is $600 billion. So we are sitting over here around $538 billion in 2020, but China is sitting at $3 trillion. Here there is 6 zeros. Okay, so this is $3 trillion and this is $600 billion, because here it's 50, and in $1 billion, $1 billion is equal to $1,000 million, and $1,000 billion is equal to $1 trillion. So China has got back from $4 trillion to $3 trillion here. They have touched to $4 trillion. So that's a very huge amount. And our economy is $2.9 trillion, which is bound to contract by 5% this year, according to RBI and Nirmala Sitharaman. So you can see a drastic change. That's only because of, first thing, the communist government of China, which can take any decision. There is no public rights. Apart from that, they have good policies regarding infrastructure, and they have a long-term policy, 15 years, 20 years. Like if Modi government is bringing bullet train project, the next government may halt it. So that's not the case in China. That's why they have better labor laws, better infrastructure, better cities, good urbanization. So they are reaping the benefits. You can see over here, and this downward slide is because of BRI, Belt Road Initiative, because of investment like in $1 billion in Pakistan, Iran, countries like Sri Lanka, and many more African countries. We are also doing good. But we have to do a lot more in different things like Industrial Revolution 4.0 as well as manufacturing. So after a brief comparison between China and India, let's move to what happened currently. So currently, in the last week, our Forex reserve have reached to $538 billion. And last week, it was $534 billion. So there was around $3 to $4 billion of hike. And in last 10 months, $100 billion, that's a major jump in the Forex reserve of India. Now you would be thinking, like in coronavirus, the economy is shrinking, 8 out of 10 people have lost their job or faced a pay cut. So how Forex is rising? That's a very good question. To answer that, I will go to RBI website. So you can also see this in publication weekly statistics supplement. What RBI does is every week, by every weekend, they publish the Forex reserve data. Okay, it's very important for RBI grade B and UPSC exams as well. So what happens is there are 4 constituents of Forex reserve. First is FCA, second is gold, third is SDR, fourth is reserve position. Okay, it's reserve tranche position in IMF. So here you can see 538,191. So it's $538 billion. Why? Because I have told you in the last slide that $1 billion is equal to $1,000 million. So here the data is in $1 million. Okay, as mentioned, it's in $1 million here. So $538 billion is the total reserve. Out of that, around $492 billion is foreign currency assets. So it's more than 90%. And in FCA, we have dollars, euro, pound sterling, and yen. And dollar is also around 90% in this. At distant second, there comes gold of around $39 billion. After that, And gold is the safest investment because the gold is limited. The demand is rising, but the supply is limited. That's why gold is a safe haven. And the currency printing also depends on how much gold a central bank is keeping in their vault. So that's why some part of the forex is gold for any central bank, either it's Bank of England or Fed Bank of USA. At third position, it's SDR. So what's SDR? Special drawing rights. So you can see $1.4 billion. So this is the amount RBI has kept in IMF. So you can anytime get 25% of this from IMF, or you can do the trade of this much value. At 4, reserve position tranche. So $4.6 billion is here. So actually what happens is reserve tranche position gives voting rights to any country in IMF. So if any voting is going on, so you have this much votes, your vote will be constituted like this. So that's how our RTP works. So these are the 4 major constituents of forex reserves, and India's reserve is $538 billion as of now. Moving forward, again you can see the reason we got a trade surplus in June. This happened after 18 years, and that was a very amazing phenomena. But that was not extremely good news, as Piyush Goyal is trying to say over here, because our export doesn't increased abruptly. What happened was our export as well as import decreased, and the import decrement was more because of the gold import decrement and crude oil decrement, because the demand was very less of gold as well as of crude oils due to the lockdown issue. So that's why we saw a trade surplus of $0.8 billion, that was more accurately $793 million. Talking about again this graph, in 2000 to 2004 you can see an increment, slight increment, and in 2012 to 2016 you can see a decrement. This was the slowdown period when the economy was crumbling due to rampant corruption as well as the slowdown, and this was the time when the government changed due to the high inflation and all those issues. So here you can see that the major reasons of increase in forex reserve is, number 1, rise in FDI, like the geo investment by different companies starting from Facebook to different US investment companies and VCs. Second is FPI hike, and FPI is for short term, FDI is for long term. FPI was drawn back in April and May, but it came back again in May and June due to the accommodative stance of RBI as well as the Finance Minister of India Nirmala Sitharaman. So in June, July, we saw a pullback of FPI, and later on also we will see an increase in FDI and FPI because the China-US trade war is going to stay till November, December, till US elections. What will happen is India will be a good emerging market for investment purpose. So all those US and European exchange borrowings and all those companies will come to India, because China is not a safe haven and there is high risk, because politics is a very crucial thing. Anything is constant, but politics is not constant. So if a country is facing a different political situation, okay, so if the relation between NATO and China is going to be bad, so no country will want to invest in China, and that's why you are seeing the companies are pulling back from China as well. So rise in FDI is the first reason. Second is FPI hike. Third is trade surplus, which we saw over here that we got a trade surplus also. And the fourth reason is the dollar INR, means dollar rupee swap. Now you can ask, why the dollar rupee swap? So see, what happens is economics work on two things, demand and supply. And when the supply of rupee is more in international market, then obviously the value of rupee will decrease. So what we have to do, we have to decrease the supply of rupee in the international market. So through dollar and rupee swap, what Indian government does is they increase the supply of dollar in international market, but that is not going to have an impact on dollar, but they get the rupees back. Okay, so if India is giving $2 billion to Sri Lanka, so they will get back their rupees. So the demand in international market of rupee will increase because there is less money now, the less INR in international market. Okay, so we are sucking the money from the international market, which is in Indian rupee. So rupee is decreasing. That's why the rupee will strengthen compared to dollar. That will be a little bit, but two main benefits of dollar rupee swap is, first, the rupee will strengthen a bit, and the second, we have to means decrease the forex a little bit, so that to strengthen the rupee. So these are the two reasons why dollar and rupee swap happens. There is a OMO thing also, through which the liquidity is controlled as the condition. So we will discuss in OMO in another video. So these are the major four reasons, and the biggest reason is rise in FDI. And you can see over here also a tweet of Piyush Goyal. And in the second slide, you can see the red mark is of import and the blue mark is of export. So here you can see both have decreased, okay, both are in negative, but the export is minus $12.4 billion in June and the import is minus 47.6. So the export has fallen less and import has fallen too much less. Why? Again, because of gold import and crude oil import, very sharp reduction in gold and crude oil import. That's why we saw a trade surplus of $793 million, that's $0.79 billion in June. But bad luck, again in July, we are seeing a trade deficit of around $4 to $5 billion, that's $4.8 billion because of gold demand. So we have imported more gold in July due to several reasons. Coming back to FPI, as I have already told you that FPI inflows is according to government decision in September. So what happened in September? The corporate tax rate was reduced. So because of that, more FPI came to India, and it's rising in June, July, August, and it will rise further also because of Cold War and trade war. FDI inflows. So the major chunk is here. Between September 2019 to March 2020, the FDI stood at $24 billion. In the 15th August speech of Narendra Modi also, you can listen about FDI. So he is emphasizing very more on FDI. So he is saying that higher the FDI, stronger the economy. Yeah, it may happen, but what's happening in the case of India, like all money is going in one pocket, like Mr. Ambani. So that's bad for economy. That's very hyper capitalist economy. So the distribution should be a little bit balanced. Otherwise, only a big fish will eat every small fish. So coming back, what happened in April, May, it amounted to $6 billion. But now, Jio has got around $20 billion of FDI. So that's a major chunk of the Forex reserve, because if any company, Facebook is coming, Mr. Juki is coming, who got a billionaire status at age 19, Harvard alumni, and he is investing in Jio. So he will come with lots of money, and RBI is sitting here. RBI will say, okay, give me the dollars. So he will, RBI will, Shaktikant Das will take the dollar and he will give INR. So he will give the INR to Mukesh Ambani. So what's RBI getting? RBI getting FCA, and what will happen? Forex will increase. So that's the case, and the major reason is FDI. One of the major reason is again crude oil prices. Let me show you through a pie chart. What happens is India's major import is crude oil. Okay, around 30 to 40% of import is oil. At second, it's gold, and at third, it's electronics imports. So what happened in coronavirus, that the oil and gold demand plummeted very sharply. That's why we saw a major forex reserve hike in the RBI. And the Brent crude was going between $60 to $70 billion in Jan 2020, but it went to $9 to $20 billion in April. Okay, and it also went to negative in US market for some time, and crude accounts for almost 20% of India's importable bill, but it varies. It goes somewhere around 20 to 40% in several years. Like in 2016, the import was around 38% oil import. But yes, electronics is going to surpass oil imports very soon, as we are focusing more on renewable energy, and the electronics demand, the gadget demand is rising, and we are very bad at fabrication plants and all those component industry. We are just doing assembling and saying it make in India. It's not make in India, it's assemble in India. So we need to focus more on electronics industry, and Taiwan can be a major partner of India, and our foreign policy is such that we are not focusing on either Tibet, Taiwan or South China Sea, and we are seeing that China and countries like Turkey are very aggressive about India, and we are not taking help of US, and our defense policy, our foreign policy is defensive. It's not attacking. Our foreign policy should be attacking, because we have nothing to lose. You can see in the first slide I have shown you our economy is $2.9 trillion and China's forex is $4 trillion. So we can't compete with China economically. We have to do something like hook and crook. We have to play politics. Till when we will keep playing politics in India only? We have to go international and we have to play politics, which is not happening right now. Moving forward, as I have already talked, like the gold import is also a major part, and due to dip in gold import, like if somebody is having 50,000 rupees in their account, so nobody is going to buy gold. They will buy wheat, they will buy pulses, they will buy vegetables, they will not buy gold. Obviously, the essential need, people moved back to essential need. That's why we saw a gold import dip, and due to that, the forex reserve also rised. But why gold price is rising internationally? You may ask. That's a very interesting question. So that's happening because India and China's import of gold decreased, but Western countries keep gold in treasury vault because there is a pattern. Like here we have sovereign gold bond and companies like Manappuram and Muthoot who give gold on loan, means keeping gold as collateral and providing loans. But in Western countries, what happens is they keep the gold as the best investment through any company. What happens when the economy is shrinking? Okay, the economy is shrinking, the market is not stable, so every investment company invests in gold because the gold is the safest thing in the world because of the limited supply of gold. In the last 20 years, you can see the gold price has moved to 10,000, from 10,000 to 50,000 rupees, almost 5 times in 15 years. So that's a safe investment. That's why Western countries are importing more, and the treasury vault is full of gold of Western countries, and that's why gold price is rising. If now you may ask, should I buy 20 gram of digital gold? So see, if Western countries will stop importing gold and India, China keeps a stance of not importing gold, then the gold price may decrease also, but that will happen less because in India we saw in July that the gold imports has increased because of the festive season as well as Akshaya Tritiya and all those things, like Dhanteras is also coming in 2-3 months, so the importers import very early due to ornament structuring and making of all those gold ornaments. So we are seeing a rise, but yes, gold is going to touch 1 lakh rupees in less than 5 years. That I can say for sure. Now you can say that how forex helps India. See, what happens is Indian government. Let me tell you a small story. Indian government is husband, okay, and the RBI is wife. Now what happens is in a normal house, husband earns the money and the wife manages the money. She is the manager of the house, and legally wife shows husband that this is the amount I have kept, but wife also hides some money in cupboard, below bed, in kitchen, and at many more places. So whatever money wife is showing to husband directly, you can say it's dividend, means husband can ask any time for dividend from RBI. But forex is what wife is saving for external shock. Like there may be a condition when husband got a startup idea in midnight and he asked her wife that I need this much money. So what wife will do is she will provide some money from forex. So for external shock, like husband is able to not repay a car loan, or he has got an accident, so in that case wife will give this money in child education, in sister's daughter, somebody's marriage. So what I want to convey is forex is for critical condition. Like 1991 we got a critical condition where we were not in the condition to pay 15 days of import bill. So in that condition forex will come handy, and luckily we have more than 1.5 years plus import dollars in the forex reserve as of now. So I have explained in layman. Now we see what's there in this. So how does it help? Rising forex reserve gives a lot of comfort to the government and the Reserve Bank of India in managing India's external and internal financial issues at a time when the economic growth is set to contract by 5%. So you know Indian economy is going to contract, and in this case forex is the best thing which is happening to India. It's a big cushion in the event of any crisis on the economic front, and enough to cover the import bill of the country for more than a year. The rising reserve have also helped the rupee to strengthen against the dollar. Yes, as I have already mentioned, the dollar rupee swap thing, how rupee strengthens, but it's less because see, when rupee will strengthen more, when we will export more. China exports in $1 trillion and we export in $1 billion. So how we can strengthen the rupee? The demand of rupee in the international market is very less, but the demand of Chinese currency is more. And China is also playing a big game of, they are not just playing trade war. Trade war is different. Beneath trade war, it's tech war, it's digital war. Through 5G, AI, ML, China is playing a big time war with US. That's why US is targeting China. And India is missing out. India is nowhere. Not in trade war, not in digital war, not in internet war, nothing. We are having a fight with Corona. Moving forward, the foreign exchange reserve to GDP ratio is around 15%. Now foreign to exchange reserve to GDP ratio. Okay, so what happens is $2.9 trillion is India's economy, and if you divide it by the foreign exchange reserve, okay, so our foreign exchange reserve is around $0.58 trillion. Okay, so you will get this percent. If you multiply it by 100, you will get this percent, 15%. So the crux is, higher the foreign exchange reserve to GDP ratio, stronger is our economy, better is our economy. So the numerator should be more, then only we will have a better percentage. So if it's equal to our total economy, let's say it's $2.9 trillion, so that will be 100% ratio. That's best case, like we will having at least 10 years of import, but that's not a practical case. Moving forward, a reserve will provide a level of confidence to market that I have already mentioned in the last slide. Like FPI and FDI will only come to India when we have a stable government, when we will have a stronger policy, better infrastructure, and the forex will be at a high. Then only the companies will invest in Indian market, and then only India can meet its external obligations. Now here I present you an interesting fact. So which all 5 countries are at top? First is our neighbor China, which is a bit attacking to India nowadays with their friend Pakistan and Turkey also. So you can see the forex reserve is around $3.3 trillion of China, and this data is of yesterday, of 17th of August. At second, there is Japan. These two are highly industrialized countries. On third is Switzerland. Now you may ask, how is Switzerland on third? Because Switzerland is the highest gold exporter. They have the largest gold export in the world. Apart from that, you know about the Swiss bank. So not surprisingly, Switzerland on at third. Russia is at fourth because of their defense industry, and here we stand at number 5. So we can beat Russia and Switzerland very soon if we work positively. And at number 6, you can see Taiwan, a small country with very less population, but they are at around $0.5 trillion. So you can ask how? Because the Taiwan has a very strong electronics industry, and India should collaborate with Taiwan because they have a very bad relation with China, and India should sign a MOU with Taiwan on electronics industry, and they should take help of Taiwan, and in that case India and Taiwan both will benefit. Because see, in India we have the market, in India we have low labor cost, we have highly skilled people also, like companies at Intel, Qualcomm and different companies. So if India and Taiwan collaborates, then Taiwan has the high-end skill, India has the market, India has the low labor cost, so we can rule the electronics industry. And if we will rule the electronics industry, then we will have the data, because all those chipsets are fabricated in Taiwan, TSMC, which is $300 billion of profit annually. So if we have the data, and the data, as data is the new oil, so we can have an edge in the internet war, digital war, where we are missing out currently. So that's my personal opinion, which many can't agree. Moving forward, the 5 questions I asked in the beginning of this video. So the first question is, when Indian forex touched $500 billion mark? So the answer is June 2020. As you can see here, that in June 2020, India's forex reached to $501 billion, and the month taken was 33 to reach from 400 to 500. The sharpest was in 2008. The global financial crisis was bound to start. In 11 months, we reached to $300 billion from $200 billion. Moving to second question, RBI has transferred how much dividend to government in 2020 to contain fiscal deficit, which is bound to be 3.5% in fiscal year 21. So the answer is 57,128 crore. And you can see over here, last year RBI transferred 1,76,000 crore as dividend to government, and that include 52,637 crore one-time transfer of extra reserves to the government. And in those 2 years, the government is getting good amount of money, and as Nirmala Sitharaman has promised that we have to keep the fiscal deficit to 3.5%. Now you may ask, what is fiscal deficit? So fiscal deficit is difference between expenditure and income of Indian government. Okay, so this is fiscal deficit. So 3.5% should be the fiscal deficit, and when the deficit will happen, when the income is less and the expenditure is high. Okay, so here we are seeing a more hike in expenditure, the income is less due to the coronavirus and the halt of economy. But now what's happening, our economy is contracting by 5%, and we are seeing a jump in the fiscal deficit, which may go between 6 to 7% as the official data from NSO. Moving forward, and one thing is also Deepam. Department of Investment and Public Asset Management. So they are not able to disinvest a lot of money. Like Air India is in a halt. We are getting less money from AGR, also from telecom companies. 5G auction is halted. So we are also having less disinvestment figure. That's why the fiscal deficit is bound to increase, because this DPAM is not working, and the government has accounted this while fixing the fiscal deficit data. Moving forward to third question, in the context of India, which of the following factors is contributed to reducing the risk of a currency crisis? The answer is 1 and 3. Why? Because second option is null and void. Increasing the government expenditure doesn't decide whether our currency will strengthen or not, because you are expanding internally. There is no relation between the external world. So how dollar is going to impacted and our currency is going to strengthen? But in first case, the India's IT sector, yeah, they are going to bring dollar from US, Europe, Australia. Third option, remittance from Indians abroad, Gulf, Australia, Europe, Canada. So dollar will come. So the correct answer is C, 1 and 3, and this question came in UPSC pre 2019. Moving forward, Indian economy has seen trade surplus in June 2020 after how many years? So the surplus was $0.78 billion, which was around $790 million, and this happened in 18 years. Here you can see in 2002 we see a hike in exports. Okay, so export was greater than import in 2002, and after that it happened in 2020. So export is greater than import in 2020 again. So this happened in after 18 years, and both happened in NDA government. But our export should be more than imports, I assume, but our policies are such that our export is not rising. That's why we are seeing initiatives like Make in India, Atmanirbhar Bharat, and so on. Question number 5, which is not part of Forex maintained by RBI? So that's an easy one. Option D, silver, will be the answer. So this is the end of the video, and I assume I have enhanced an iota of your knowledge. And if you think that I have enhanced your knowledge, so do like or dislike. If you don't like the video, do dislike, but do like or dislike. Don't move away without liking or disliking, because that will demotivate me. If you liked my effort, if you liked my hours of hard work and research, then do like. Or if you didn't like, drop a dislike and comment why you disliked it. And if you have liked it, share as much as possible across all those WhatsApp group, Telegram groups. That will motivate me to make more videos on topics like dividends, trade war, more economics videos. And thank you for watching. Do share and subscribe if you like my hard work. Thank you for watching. God bless you all.